If you've been following the financial markets, you're probably aware that large cap stocks have been outperforming small cap stocks for a long period of time. Well, in this video, I'll discuss that in depth and also talk about some potential opportunities where you can take advantage of small cap stocks if you'd like to increase your exposure to them. Welcome back. This is episode 226. So far this year is shaping up to be another great year for the stock market. In particular, the S&P 500, which is the 500 largest companies in the United States, is having another great year. However, there are areas of the stock market that aren't doing as well, and one area is small companies, otherwise known as small cap stocks. And this represents the smallest publicly traded companies in the United States. And I want to talk more about that in this episode as far as what small cap stocks are, the potential opportunity that there could be in performance in the future, and also talk about some ways that if you want to take advantage of this, where you can invest in small cap stocks. So if you're new to my podcast, my goal is to help deliver tips and tricks for retirees and pre-retirees every week as you're looking to plan the ideal retirement and then manage your investments through that process. Consider signing up for my weekly newsletter where I help bring that information right to your inbox. To sign up, head over to retirewithryan.com, scroll to the bottom of the page, and sign up for my newsletter. So, first of all, what are small cap stocks? Well, according to Investopedia, a small cap stock is a public company whose total market value is between $250 million and $2 billion. Now, what is market value? Well, that's simply the stock price times the number of shares that determines the value of a company. Now, this $2 billion number can vary because some people use up to $5 billion as a definition for small cap valuations, that is. And small cap, if you invest in small cap stocks, you're looking for up and coming companies that can grow at a fast rate and hopefully grow to be much larger companies. Whereas a large cap stock, which would be the S&P 500, are stocks that have a market capitalization, so again, stock price times the price per share of 10 billion or higher. And for example, large cap companies like General Electric, Coca-Cola, they are much more stable companies. Probably their periods of large growth are behind them. And these companies offer potentially more stability than small size companies and also a dividend. So when you're investing in small cap stocks, you're hoping that you're going to get much more growth out of them than you can out of a large cap stock. It makes sense. A smaller company that only has maybe a few products, a few revenue streams, can more quickly grow that revenue stream, especially if it's a new product or they're going to new markets, whereas a larger company that's already doing business globally, has already saturated the market, doesn't have as much growth potential. So what are the pros and cons of small cap stocks? So some of the pros are, as we talked about, that potential for growth, a lower share price. Small cap stocks are usually not going to be trading for hundreds of dollars a share, possibly even $1,000 or more a share. So there is a smaller price that if you want to buy shares, you can more easily do that. There's a lot of businesses that small caps stocks are investing in or are doing business in. So you don't only have to rely on just one particular area. You can get diversification across the whole economy through small cap stocks, all industries. And because they're less popular, they're not as well known, that means there could be some real potential appreciation because most large cap funds cannot invest in small cap stocks. So that means there's usually less people investing in these companies. Well, what are the disadvantages? Well, because of this potential for growth, there's also potential for major swings in price. Small cap stocks profitability can change really quickly, which means there can be a lot more volatility. This lower share price also can be problematic because it can mean that there could be less people investing in it. As we said, that can be a negative because there's not as much demand as there would be for a larger size company. And small cap stocks, just like large cap stocks, can go bankrupt, but it's a lot more likely to hit a small cap stock because of the fact that they're a much smaller company and they could be much more susceptible to changes in the economy or just changes with the company themselves. So why is there this growth potential in small cap stocks, as I mentioned? Well, According to an article that I found on A Wealth of Common Sense, small cap stocks have overperformed large cap stocks over a majority of the past. So a number was referenced that from 1926 to 2021, so almost 100 years, small cap stocks' average annual return was 11.9%, but for large cap stocks, it was still impressive, but a little bit less at 10.35%. But if you delve into the data, a lot of that outperformance came from 1975 to 1983, which is where small cap stocks were up more than 14% during that less than 10-year time frame. So if you take that away from the performance out of the numbers, that is, small cap stocks and large cap stocks have performance that's much closer to each other. And people often ask, why was that 8-year period so good for small cap stocks? Some people have referenced that there are stocks known as the Nifty 50 that were large cap stocks that really fell out of favor, that caused people to invest in small cap stocks. And also there was a change with ERISA, which governs retirement plans, that allowed pensions to actually invest in small cap stocks, which potentially caused a flood of money into them. So again, if you look over the long haul, small cap and large cap stocks performance has been relatively similar. But what if you zoom in on the last 10 years? Well, over the last 10 years, large cap stocks have significantly outperformed small cap stocks. So from 2014 through 2023, large cap stocks, as measured by the S&P 500, returned a cumulative return of 130%. But small cap stocks, as measured by the Russell 2000, only returned a cumulative return of 83%. So about a 50% difference in performance. And then if you look at 2024, so far year to date, large cap stocks are up 23% year to date, and small cap stocks are up less than half, only about 12%. So there's definitely been some more recent underperformance, and that is why there could be a good opportunity for potential growth of small cap stocks. So why might there be a turnaround? One reason is that small cap stocks generally tend to do better when interest rates are going down. If you think about a large company that's borrowing money, they're usually going to pay a lower interest rate than a smaller company that maybe doesn't have as good of a financial credit rating or maybe has more debt than a larger company. So as interest rates are going down, that's very beneficial for small cap stocks. Additionally, when you have these long periods of outperformance, that can also be very good for small cap stocks. During the dot-com boom of the 90s, large cap stocks significantly outperformed small cap stocks, but then from 2000 to 2010, large cap stocks significantly underperformed small cap stocks. Small cap stocks made about an average return of 10% per year, where large cap stocks only made a return of 2% per year. So it is possible that there is good opportunity going forward for small cap stocks. Now, some people have argued that this premium, this small price premium of small cap versus large cap stocks maybe is completely gone. Maybe it's possible that large cap stocks, because of the additional monies that larger companies have to invest in innovations, to invest in AI, that small cap companies are really not going to offer the same potential that they did in the future. So the future is always unclear, but it's definitely unclear about this. So if you do believe that large cap stocks will, end their run of outperforming small cap stocks, then how can you invest in them? Well, there's a number of ways that you can do that. One way is through your 401k. Hopefully your 401k offers small cap funds. Now, I've reviewed hundreds of 401ks for clients, and I will say that most 401ks are pretty lacking when it comes to a selection of small cap funds. Some of them do have them, but usually there's only one, maybe two funds to choose from, whereas compared to large cap funds, there's usually at least a handful of funds. So I'm a big believer in using index funds. Index funds are not trying to outperform the market, they're just trying to own the index. So there are a number of different small cap indexes that you could potentially invest in. One of them I mentioned earlier, and that's the Russell 2000. That's the 2,000 largest small companies that you can invest in. So that's one way to do it, but I'm more of a fan of using what would be the S&P 600. So the S&P 600 are the 600 smallest companies in the S&P universe, but however, those companies actually have a profitability screen. These companies have to be profitable. If you look at the Russell 2000, there are many companies in the Russell 2000 index that are not profitable. So if I was recommending what to invest in, I'd rather you invest in profitable companies than unprofitable companies. So you could focus more on the S&P 600 index as far as the type of fund that you're investing in. And it depends on what your 401k offers. Maybe they only offer actively managed small cap funds, which generally tend to be more expensive than index funds. If that's all you can select from, then that might be your best bet. But if you do have the ability to move your money out of your 401k, whether you've already done that through an IRA rollover or you're going to consider doing that in the future, you then have a lot more options to invest in. And I would primarily suggest looking at exchange traded funds, a type of index fund that is available through an exchange traded mutual fund. So one that you can invest in is VB. That's the Vanguard Small Cap S&P index. It actually tracks the Crispin index, which is a larger universe of stocks beyond just the S&P 600. That'd be about 1,300 holdings, and this has an annual expense ratio of 0.05%, so that's pretty good. Another one that you could consider is the IJR ETF, and that's iShares Core S&P 600. So that I like better because it is just 600 profitable names, and that has an annual expense ratio of 0.06%. And my favorite would be using SPSM. This is State Street Spider's S&P 600 index, just like the iShares index, except its expense ratio is half at an annual rate of 0.03%. So that's what I personally use for my money, for my clients, because I like the fact that it is the S&P 600, the profitable companies, but also it has the lowest expense ratio of any S&P 600 ETF that you can invest in. Now, historically, what does the best in small cap are actually value stocks. So value stocks are stocks that are small cap companies that have been in existence for a while, but are trading at a discount, trading for a value. So if you want to invest in that, one fund that you can use is State Street Spider's Small Cap Value Fund, which is SLYV. So that's the S&P 600 with a value tilt, but it is a little more expensive with an annual expense ratio of 0.15%. So if you are considering investing in small cap stocks, obviously it carries more risk than large cap. You have to balance out that risk with what your risk tolerance is, but it's definitely a good idea to look at your portfolio, get an idea of how much small cap exposure you have. By and large, most portfolios that I see have only a couple % of small cap exposure. So if you believe that there's a potential turnaround for small cap, maybe you want to increase that, bump it up to 5%, 10%, maybe more, depending on where you are with your financial situation. That's where your financial advisor can be helpful in discussing your allocation. But you can do that by potentially increasing what you have in your 401k, or if you have an IRA, using one of the index funds that we talked about. So I hope that was helpful on small cap funds. Definitely check out what your allocation is there. And if you have a listener question that you want to have considered for a future episode, you can head over to retirewithryan.com and click on Ask a Question. Have a great week, and I look forward to talking with you next Wednesday. Take care.